Are you going to be a passive investor? Are you going to outsource your investments? Or are you going to be an active investor? So let's break this down. Passive investing is you are investing your money yourself, but you're going to keep it pretty hands-off. And you could do this in the stock market, you can do this in real estate, but the whole idea is you have the money to invest, you want to do it yourself, but you don't want to pay somebody else to do it, and this can be a great strategy for the right person. So let me show you how to be a passive investor in the stock market and in real estate, because in the stock market, we know that the stock market has grown by around 10% a year on average for the last 100 years. This does not mean that the stock market always goes up. This does not mean that the stock market goes up by 10% every single year. It means on average, despite the economic booms, despite the market crashes, the stock market has averaged 10% a year. Now, the way you can be a passive investor in the stock market is just by owning a piece of the economy. It's not by trying to go out and find the next Amazon or the next Tesla. It's by finding a fund that will give you exposure to the broad American economy, and then you just keep investing your money into it. For example, again, I can't tell you what to invest in. I'm just showing you this as an example. If you wanted to invest in the broad American economy, VTI is an ETF that gives you exposure to the total stock market, meaning this is a fund that will give you exposure to the American stock market, and you can invest in these funds on pretty much any stock brokerage that is out there. But if you want to get a little bit more niche, SPY is a fund, an ETF, that will give you exposure to the S&P 500. That's the 500 largest companies in the stock market. So if you wanted to invest in the American economy, these two funds will give you exposure to the broad American economy. And now if the stock market goes up, well, generally these funds will go up. If the stock market goes down, generally these funds will go down. And we know that over the long term, the stock market has grown by around 10% a year. But the way that you win as a passive investor here is by following a strategy I call ABB. Always be buying. And that means now you need to create a system where every week, or every 2 weeks, or every month, money is going to be automatically invested into your funds. Whether the markets are going up, whether the markets are going down, whether the markets are sideways, whether it's a Democrat in office, whether it's a Republican office, whatever's happening in the world, you keep buying. And I say this strongly because anytime you see markets go down or volatility or concerns about the economy, people freak out. And then they ask, should I sell? And then they get panicky. But the way that you win is to be a long-term investor, invest for years, if not decades, and just following ABB into the broad American economy, because we know that recessions happen, we know that market crashes happen, and they will continue to happen. And the only thing you might want to change is buy more next time that crash happens, because that gives you the opportunity to buy more good assets at a discounted price. To passively invest in real estate is a little bit different. When I say real estate investing, I'm talking about investing in properties, buying physical houses or apartments or office buildings and then renting them out. That is active. But if you want to passively do that, there are funds out there on the internet where you can just invest your money like you would in the stock market, but instead of investing in the stocks on the stock market, you are getting exposure to real estate funds. And now, because of how fast the internet has been growing, there are opportunities for you to just follow something like ABB, where you can invest every week or every few weeks into these funds, and it can be completely passive for you while you're getting exposure to physical real estate. So if that's something you're interested in, you just go into Google and search some of these crowdfunded real estate deals, crowdfunded real estate opportunities, and now you can invest your money into these funds and keep it passive on your end. Option number 2 is to outsource your investments. So in the stock market, that would mean essentially getting yourself a financial advisor, because now what you're doing is you're going to pay this financial advisor generally with something called AUM, assets under management, and they were going to manage your investments for you, hopefully get you better returns, but then they're going to have to take a fee, a cut of your investments. The AUM essentially says for every $100 you invest, how much is the financial advisor you're going to get. Let me show you what this plays out to be. Let's assume that you invest $1,000 a month. You do this for 30 years, and now because you have a good financial advisor, you can get a, let's call it 11% return on your money. That's better than what the stock market has averaged, but now your financial advisor might charge you, let's call it a 1.5% fee. Now we have to take a look at how much money you're going to generate after fees. This will add up to around $1.9 million, which is pretty good. Now, if you invested your money yourself into the stock market and got a 10% average return on your money, well, you would have actually ended up with more, because now you don't have to pay the 1.5% fee. You would have ended up with closer to $2.1, $2.2 million. But the $200,000 to $300,000 difference is what you were paying in fees. And yes, it can be a lot in fees, even though it's a small 1.5% fee, because that 1.5% fee is going to compound along with your investments. But if your advisor can get you better returns, well, then that fee can definitely be worth it. So this is a great option for some people. You just have to understand how the fees work and make sure that the advisor that you're working with is aligned with your goals. You can also outsource your investments into real estate. This is often called syndicate real estate deals, where now you're going to find a real estate developer, you're going to find a real estate investor who is looking for money for their next real estate deal, and you're going to cut them a check, and now you have a piece of ownership in this property. You don't have to do any of the work. They're the ones that are managing the deal, they're the ones that are managing the money, and now you just sit back and hopefully they're gonna make money and give you a return on your investment. Again, this can be a great option for some people that want exposure to real estate but don't wanna actually have to do the work. But you have to go out and find those people. It's not as easy as it is working with a financial advisor, but certain financial advisors might even be able to connect you with those types of real estate deals. Otherwise, you can go to a real estate investor conference. There's always investors and always developers that are looking for money. Then option number 3 is to be an active investor. And this is what most people think about when you say be an investor. So in the stock market, this means now trying to find a company that you believe in for the next 5, 10, 20, 30 years. But the whole way that you succeed here is not just to invest based off of what you see on the headlines, because the mistake that so many people make is they hear about a stock on CNBC or Reddit or Yahoo Finance, and then they invest in that stock because it's on the news. But the reality is, by the time it's on the news, the real money has already been made. So you want to understand, if you really want to make money, how can you find those investment opportunities before it's on the headlines? And that's where your research, that's where your data comes into play, because your research and your data is going to help you understand those investment opportunities and help you find those investment opportunities before everybody else. Now, this is more risky for more potential returns. But if you can get slightly better returns, it can add up to hundreds of thousands, if not millions of dollars of more wealth over the course of your investing career. Because if you can get just a few more percent a year on your portfolio, the few more percent can compound year after year after year to give you more wealth. Again, is it guaranteed? No, absolutely not. Investing is risky, but the way that you can lower your risk now as an active investor is by investing in your own research. Because if you can find those opportunities, you're doing the research to understand where money is moving, that can help you understand why you're making that investing decision. Because a lot of people are investing their money because a lot of people are talking about it on Reddit. But when you invest based off of all that public information, you're doing what everybody else is doing. And when you do what everybody else is doing, how do you expect to get better returns than everybody else? And that's why I want you to start thinking like an investor and understand, if you want to be an active investor in the stock market, this is all about what is your research. This is what I talk about in my masterclass on how do you actually do that research and how our firm does that research. Again, if you want to register for that masterclass, the link is for you down in the description. And with real estate, well, it's a little bit different. With real estate now, you're not investing in stocks. You're going to actually go out and find those properties. You're going to go out and buy the rental properties, whether it's a single family house, an apartment complex, an office building, a storage unit, or whatever type of property it is. And you're going to rent it out to other people. This can be a great way to invest your money, but it's going to take more work. It's going to take more time. It's going to take more effort, but you also get better tax breaks. And you can also get the returns for yourself. So it just depends on how involved you want to be for investments. What I learned very on is I like this active side of investing. That was interesting for me. I also like this passive side of investing as protection against my own mistakes that I make as an active investor. So for me, I became an active investor first, then I added on this passive investing to help layer on top of that. But you have to know what's right for you, because the mistake I see so many people make is they say, I want to be a long-term investor. So now you start investing in random companies you see on the internet, and then as soon as the stock starts to go down, well, now you sell and you turn from being an active investor into a trader, and that kind of flips the whole script. Or you say, I want to be a passive investor, and you invest your money into the S&P 500, and then markets go down and now you turn into a trader and you say, you know what, I want to invest in these random companies. So you got to know your strategy. If you want to invest as a passive investor, great. Understand ABB. If you want to work with a financial advisor, you want to work with a developer, you want to work with a way where you just are hands off, great. then follow that strategy. If you want to be an active investor, great. Invest in your own research. Understand it's more time, more work, more effort, and more risk for more potential return. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.